Okay.
Yeah.
All right.
Yeah.
So this chapter is about accounts receivables. Do you remember what kind of accounts receivables is?
Accounting formula.
What was that?
Sorry, I'm thinking about the accounting formula.
I'm going to guess that I heard someone say it's an asset. Yes?
Yeah, it's an asset.
Okay, that's what I thought you said, Nathan. Okay, so this asset represents money owed to us, right? When we've done work, and we'll say in your homework that you've provided services on account. So we would, remember the word services provided is revenue. So we would credit service revenue and we will debit accounts receivable when it's on account, meaning we did some work and we haven't gotten paid yet, right? So there's going to be new accounts associated with this. Does it say credit sales on your slide now?
Mm-hmm.
Yes, okay. So whenever you sell your product on account, there are some issues. Sometimes, or we're doing services really in our class right now, but sometimes people don't pay you that money that they owe you, right? Like you go and you wash their car or you cut the grass for them or whatever, and they say, I'll pay you next month. And sometimes they don't pay you for that. So we're going to learn in this chapter how you account for those, what we call bad debts. But before we do that, we're going to discuss some other issues that you happen to encounter sometimes when you provide services on account. So the service they're talking about here is getting your teeth whitened. If you go to the dentist and you're thinking about getting your teeth whitened and they say it's going to cost $500, sometimes they might say, oh, but I'm so glad you came in today because, I'm going to switch through this because it's not that important. Sometimes they'll say our product is on sale and they call that a trade discount. We do not have a separate account for trade discounts. It's just when something is on sale, you can see in this journal entry down here, you see that it says $400 now. Maybe a couple of you. It said $500 before. Trade discounts, there's not a new account. So when you see that verbiage in your textbook, if you look through it, or if you see it on your homework, the trade discount just means something is on sale. You went into the store and they said, today it's 20% off. Well, they're not going to record as much revenue as they would have if you had to pay full price, right? So we're still debiting receivables and crediting revenue. Then the next thing you have to learn, besides trade discounts, you really won't be tested over, but you just need to know what it was. It just means something's on sale. These are two new accounts that you will be tested over. You have 3 contra revenues in this account, in this chapter. So sales is a real revenue, right? Sales is a part of which category? Assets, liability, or equity? Where do we put sales revenue? Remember? Let me tell you your choices again. Sales revenue is a part of assets, liabilities, or equity.
Equity?
Equity.
Good job. Equity is correct. 5,000 points to Ozzy. So sales revenue, every time I provide work or services, increases equity. But these two accounts, and one other one I'm going to tell you about today, are actually contra revenues. So remember the word contra, we've heard it before in class. It really means the opposite, right? So these accounts are not going to increase equity. They're actually going to decrease equity. One time, I don't know if I told you this in class or not, but one time I ordered a soccer ball online from Amazon. And when it came, it was like miniature. I was like, what the heck, man? And I went online and I was going to return it. They said, just keep the soccer ball and we'll give you your money back. So that is an example of a sales allowance where the customer is not required to return the product. Sales return, hence the word return, the customer has to bring back the product, and then whoever, the retailer or the business, gives them their money back or takes that charge off of their account, right? So the difference between these two accounts is basically that top line on this slide here, on the bulleted points. The sales allowance is used when a product is not returned. A sales return, that account is used whenever a product is bought back, okay? So moving on with that example of teeth whitening. If you go to the dentist and you get your teeth whitened, but then you don't like it, you're dissatisfied, you cannot give the whitening back, right? Like you can't take the whitening off your teeth and give it back to the dentist. So they're going to have to use the sales allowance to adjust the amount that you owe for the teeth whitening, right? If you bought paint and you put it all over your walls and then you decided that that paint was really poor quality and it was already chipping, you would take back like the empty paint can, right? And so they would give you your money back, but they would have to credit their cash and debit the sales allowance because you can't return that product. Okay, so on with the teeth whitening. What they do when you say you're dissatisfied is they debit sales allowance, because remember, sales allowance is a contra revenue. It has to have the opposite of normal revenue. It actually looks a little bit like an expense. It reduces your total revenue. It reduces your net revenue. So far, we have discussed that there are two new accounts called sales returns and sales allowances. They are both contra revenues. We're going to add one more to that list. It's called a sales discount, not the same thing as a trade discount. It's called a sales discount. So what it is, do you know what an invoice is? You familiar with that term? Yes, most of you are saying yes. It's just a fancy word for a bill, right? So if the dentist sends you a bill and on the bill there are terms that look like this, do you see this second line, the dotted where it says links, dental offers D terms of 2/N? You see that part right there? Okay. So on the bill, on the invoice, if it says some kind of terms like this, if it says 2/10, comma N30, it will mean that if you're the customer, you can take a 2% discount off of your bill. You can pay less. You can owe less than $350. You can owe 2% less if you will pay that bill within 10 days. Why do companies offer those kinds of discounts? Any ideas?
To get you to pay it back.
Get you to pay it back faster, right? They want their money as soon as possible. If you own a small business, one of the biggest problem for a small business is their cash flow. They need cash coming into their business, right? So they can spend that cash on new things or additional costs, paying their workers and paying advertising and stuff like that. Also, the longer somebody owes you money, if they owe you money for a week, you're like, oh, they'll probably pay me, right? If they owe you for 2 weeks, you're like, I'm not sure if they're going to pay me. If they owe you for a month, you're like, I might not ever see that money again, right? They owe you and it's 3 months later, you're like, nope, I'm never receiving that payment, right? So the longer a debt is outstanding, the less likely it will actually be paid in full. So people will offer these kinds of discounts in order to receive payment quickly and also at least to guarantee 98% of the bill is paid, right? So what happens is when the customer pays, if they pay on March 10th and the service was offered, I think March 1st, it is within the 10 days. So the journal entry will look like this. And that is going to be one of your first homework problems. It says record the services on account. So that would have been debit to accounts receivables and credit to service revenue. And then it says record the receiving of the payment. So it's going to give you some terms like this. And the 2 represents, do you remember what the 2 represents?
2% off.
Good, excellent. Yes, 2% off. What's the 10 represent?
10 days to pay it.
Good, excellent. They only get to take the 2% off their bill if they pay within the 10 days. Perfect. The days to utilize that discount. Excellent. Then the N/30 means it's N is really for net, but I teach it that it's no discount. If you don't pay within the 10 days, there's no discount. Like you pay on the 15th day, no discount. And you have to pay the full bill in 30 days. That's the days it's due, is that last number. So this could say 1/5. It could say 5/15. That's up to the company, how they want to set that up, what kind of discount they want to offer. Okay, questions on that? Feel all right about that? This is another contra revenue. So we have discussed 3 contra revenues. Contra revenues have a normal debit balance. Contra revenues decrease equity. All right, I'm going to move on then to the latter. Oh, I do want to mention this slide. This is on your homework also. Net revenue is where I take the initial revenue amount and I subtract off any contra revenues. So if there was a sales return, it would also be listed here on the income statement right below, you know, these other contra revenues. So it's always my initial revenue is listed minus any contra revenues. So you'll have that on your homework also. I'm going to go kind of fast through some of these because actually, let's see if you know this answer. The effect of a sales allowance will result in which of the following? Any guesses? The effect of a sales allowance.
B.
What was the guess? I think I heard the right answer.
B.
B is correct. Very good. Your sales allowances do decrease your net income. Your sales returns and your sales discounts would also decrease your net income. Good job. Okay, so then moving on to, that's okay, you can, that's the same thing we just talked about. Take your total revenue and subtract your discounts or allowances or returns. The next part of the chapter talks about when people don't pay you. You have 2 methods that you can use. You could either use allowance or the allowance for uncollectibles, and it's called the allowance method, or you can use the direct write-off method. In this class, we are going to focus on the allowance method. The allowance method is the one that is GAAP approved. The allowance one follows the matching principle, and the allowance method it's for corporations because they have really large amounts of accounts receivables. So we need to know if some of those receivables are really never going to be collected. Because accounts receivables are assets. Assets make our company look good. But if those accounts receivables are never going to turn into cash, then they're really not valuable. We need to reflect what portion of that accounts receivables do we think we're not going to collect. So the allowance method is the one that is part of your generally accepted accounting principles. And it uses this terminology of what is net realizable value, so how much we really think we're going to collect from the accounts receivables. Okay, so this is kind of the last slide I'm going to talk about before I do a problem. Because on the allowance method, we're going to have 2 journal entries. The first journal entry is going to be an estimate of how much we think we're not going to collect from our customers. And it will be done at the end of the accounting period. It's part of those adjusting entries. It will be, as the very bottom of this slide says, it will be a debit to a bad debt expense account. And then you will credit, here's where some students are going to get a little bit confused. You are going to credit an account called, it's a new account, allowance for uncollectibles. It's a part of your assets. It's a contra asset. So it's not the same thing as a contra revenue. Those were those accounts that had the word sales on them. The allowance for uncollectible is a contra asset. You remember me saying before, and we're going to use the percentage method. So here's what the journal entry looks like, and then I will flip over to my problem. You remember me saying before that contras, I kind of gave you an analogy for them. They always have something going on with them. Anybody remember what I said about contras?
Always opposite. Are
Okay,
they
good.
contradict themselves? Is that
Excellent. They are always opposite of whatever category they're in.
okay?
And they always have a
Did he say
on
something
the
about
tip of
contradict?
your tongue. They always have a mama, right?
Oh,
The
okay.
contras are the babies, right? So this account, allowance for uncollectible, it's a baby. Do you know who its mama is?
Can you give us a hint?
It's what this whole chapter is about. Which account? What did we first say when we came into the lecture?
Oh, sales or no?
It's connected to that one, but it's not that one.
Allowance of uncontrollable.
The allowance for uncollectibles is the baby to, I think, let's see here.
Accounts receivable.
Oh, someone said it. I was going to say, I think I heard somebody say it. Yes. Somebody said it. Accounts receivable is the mama. You would never have this allowance for uncollectibles. Think about what this account says. This allowance for uncollectibles says, here's how much I think I won't collect, right? If this company is owed $20 million from their customers, that's what's in their accounts receivables, $20 million, and they estimate that 30% will not be collected. This is really a 6 million. They don't have all the zeros on there, but this is the portion I think I won't collect. Well, I would never have an amount that is uncollectible if I hadn't let them receive my services on account, if I hadn't ever created accounts receivables, right? So I'm going to stop sharing this real quick and go to a problem. I think this is from homework question 3 and 4, maybe. Let's see. It's around there. So what I'm going to do is I'm going to put it on this whiteboard. See if you can see it. Can you see the whiteboard with this problem written here? Kind of, sort of. Are we okay?
Yeah.
Okay.
Yep.
So on your homework, I believe it's question, like I said, 3 or 4. It's going to ask you to record the adjusting entry. So looking at this problem, it says, in year 1, the company, and your numbers will be different, remember, but these journal entries that I type out are going to be exactly the same as what you should put in your homework, but you need to use your amounts, right? It says the company provided services on account. So that right there, services on account of 140,000 was what I initially recorded as my accounts receivable balance. But then we collected $100,000. So how much is really still owed in the accounts receivables? Do you know what the balance would be now in accounts receivables?
$40,000.
Good. Yes, 40,000. So we are saying then, first we have to figure that out. Look at your homework and figure out what's the balance in accounts receivables. We're saying they think 30% of that won't be collected. So when you make your adjusting entry, remember we're going to make this adjusting entry for bad debt expense at the end of the month, year, or quarter. It's going to be an estimate. I'm going to label it as an adjusting entry just so you know what's happening at the end of the year. I'm going to debit bad debt expense and I'm going to credit bad debt expense is the debit. And I'm going to credit the allowance for uncollectible. I'm going to debit bad debt expense for 30% of the 40,000. So 40,000 is owed to me. When I multiply that by 30%, it's going to say I need to record a $12,000 expense. Any questions on how I came up with that $12,000?
So you, see if I can do this. So you did 140,000 minus the 100,000 to get the 40,000,
Good.
correct?
Yes.
And then the 12,000 was the 30% off estimate of the 100,000.
Of the 40
the
that was still
40,000.
owed to me. Yeah. The
Okay.
40,000 represents my accounts receivable balance.
Okay.
I before E except after C. Is that right? So if 40,000 is owed to me and I think 30% won't be collected, I want the balance in the allowance account to end up being $12,000. Now, this is assuming there was nothing in that allowance account initially. So if there is already a balance in the allowance account, it's going to change our problem a little bit, but I'll get to that in a minute. Do you know what is happening to the accounting equation whenever we do this journal entry? Any guesses?
Do you assets decrease?
Very good. That is right. Because that allowance account is an asset, right? Even though it has the word contra on it, all that's telling me is that its balance should end up being on the credit side. It's still an asset. When I credit assets, they decrease. So Ozzy is right. Assets decrease. What else happens because it has to balance? What does that expense account do?
It increases.
Okay, the expense increased, and where does the expense live? Which of those
Yeah.
categories? Which one?
And equity,
In equity, very good. And what does it do to equity though? Because
the opposite of what other things do to equity.
it's a negative type of account, right? And this has to balance. So I can't say that assets decreased and equity increased. So equity is actually decreasing also. And we're not touching liabilities, okay? When we do that entry. Now the second entry it's going to ask you to do on the homework is called a write-off entry. The write-off entry happens once this was an estimate up here, this first one that we did, right? When I really find out that somebody's not going to pay me, let's say, who do I want to pick on today? Oh man, I'm going to pick on Austin because I don't think he would ever do this. But let's say Austin was sniffing too many markers and he got thrown in jail for that. So when he goes to jail, I get a letter that says, Austin is bankrupt and he can never pay you the money that he owes you, okay? When that happens, I am actually going to write it off of my records. I'm going to take his balance owed to me off my accounts. So I will take it out of this allowance, the allowance account. I will debit the allowance for uncollectibles on my write-off entry. And it says Austin owed me $10,800. That was an estimate. I got to take it out of that estimate because I really, really am actually writing it off. And I have to credit accounts receivables. And in real life, we put a real name next to this. That's why I'm picking out somebody in class. We don't just write off a random account or various accounts. We're writing off a specific client's account because something happened. If that client dies and they can never pay you, you need to write it off your accounting records. Or like I said, if you get a bankruptcy letter in the mail from a client, then they are legally not obligated to pay you sometimes. So when I write it off, this could be next, it says in the problem, it's next year. That, when we look at it and we say, what did it do to my accounting equation, is really an important part of why we like the allowance method. So let's talk about that real quick. The allowance for uncollectible is what kind of account? What is that allowance for uncollectible? Any guesses on what kind of account it is?
What was the question?
That top account there, allowance for uncollectibles.
Has to be an
Yeah, contra asset.
Very good, contra asset. So when I debit the allowance account, it's just like debiting an asset. So I'm actually increasing assets when I debit that, right? Just because it has that word contra in there, don't let it confuse you. It's still an asset. So we debited an asset there. What kind of account is accounts receivable?
It's an asset.
Very good. It is also an asset. So what we say happens when we did this write-off entry, total assets stay the same. We're not increasing our total assets and we're not decreasing our total assets. When did we decrease our assets on this example? Maybe when we did that adjusting entry up there, right? Hey, can you see me on the camera?
Yeah.
Ken, do you know what I'm gonna say? Do you remember what this means?
No.
No! Whenever we did that adjusting entry, we recorded bad debt expense. That bad debt expense only happened because we recorded revenue on account. So that adjusting entry that we recorded for $12,000 follows the matching principle that says revenues and expenses are related. And when they happen, they need to be recorded in the same month, quarter, or year if they have a relationship with each other. I would never have bad debt expense if I didn't have revenue on account, right? Like they are related to each other. So I already posted the decrease to my equity back in the first year. Then when I have to write something off, it's no big deal. It's no effects. I already accounted for it. It's impact already happened in the same year as the revenue. Okay. So there's one other final important thing on this example, if you can stay with me. If you need to go anytime, you always feel free to go. But looking at these two journal entries, okay, we credited allowance for uncollectible for $12,000, and then we debited it the next year for $10,800. So does it have a balance remaining in it right now after these two journal entries? Nathan says yes. The allowance for uncollectible now has, balance is now $1,200, right? You see that where we say 12,000 minus 10,800? Is it a $1,200 credit or debit balance right now?
Debit?
Say the other one.
Credit.
Credit. We credited it for 12 and we debited it for 10.8. So there's still a $1,200 credit in there. So now, when we go to do the adjusting entry again at the end of the second year, we are going to have to account for this $1,200. What we're going to do is if our accounts receivable balance, let me try to move this up so I can still type. If our accounts receivable balance, let's say it over here. If it'll let me, yeah. End year 2. If accounts receivable, I'm just going to abbreviate because I'm running out of room, was $60,000, let's say, and we still wanted to do a 30% entry, that would equal, what is that, $18,000? We are not going to record $18,000 on the adjusting entry. We are going to record bad debt expense for $16,800. What? Why, Tal? Because the $18,000 is what we want the allowance account to end up being. We want the balance in the allowance. It's like a Dr. Seuss rhyme. We want the balance in the allowance to end up being $18,000 on the credit side. But if there's already $1,200 in there, I only need to add $16,800 to it to get its balance up to $18,000. Does that make sense? I know it's confusing. Here's a way you can just help yourself on the homework. If there is already a credit balance in the allowance account, you need to subtract that before you put in your adjusting entry amount. If there is a debit balance, do you know what you would do with it? No guesses? If there's a debit balance in that allowance account, you're going to have to add it to this percentage that you calculate. The credit
The
balance,
30%.
yes, to the 30%, correct. The credit balance means there was some left over from last time. Like I make an estimate and then I only used up 10,800, right? Off Austin's account. So I had some left over last time. So I don't have to make as big of an entry next time. But a debit balance would mean I didn't put enough in last year. So I'm going to have to make a bigger entry the next year. So debit means I would have to add it to the calculation. A credit balance means you would have to subtract it. Okay, so now we're running out of time. Do you want to do the Kahoot or do you want to, I could send it to you.
We all do it.
You want to do it? How about this? I'll go ahead and put it on here right now. And if you don't want to do it right now, you can hop off. You can say, leave the meeting. Can you hear the music already?
Can you send
No.
it to?
Yeah, I can send it too.
Okay.
Oh, okay.
Turn my volume down. It's 6 questions and it just recaps some of the stuff we talked about today. So if you want to do it now, I'll hang on here and you can sign into www.kahootit and put the pin in. If not, do it later and check yourself. I was worried about students having to get
I'll
on
call you back.
multiple
Okay, I'm busy.
tabs.
You're what?
Are you able to get on another tab
Yeah.
Oh, we have to go on another tab and do this?
or get on, I know a couple students this morning got on their phone, but Min's in. Anybody else up for it?
Everyone's
One-on-one challenge. Are any other your other instructors doing Zoom? A couple of them.
So we have to download the app, right?
For Kahoot?
Yes.
No, it's just a website. If you
Oh,
just
it
go
is?
into
Okay.
another tab and type www.kahootit, KAHOOT.it. Do people still say www?
I've never heard someone say www.
That makes me old to say that.
Or
Baldy?
URL.
I'm gonna win this.
It's a mom thing to say www. Okay, I'm gonna start the game. Are you ready? Ozzy, are you ready?
I'm getting there. My phone's kind of slow. I just got it.
We'll give her
Hold
a
on.
second.
I got to put on the pen, I think.
But always
Yeah.
feel free to jump off if you need to go. You
Okay,
in?
I'm putting in the
I
pen.
think she's in.
6, 3. Okay. I have to have a nickname.
Yeah, you have to have a nickname so it'll show up on the screen. Are you
Okay.
Pooh Bear? Here we go. First question. What kind of account is sales returns?
No shit. Or goodness. instead.
You've got 10 seconds. Better make a selection.
How do you?
Okay, so 50-50 here. The sales word should hint to you that it's a revenue. Okay, we did discuss a different account today called a contra asset that was allowance for uncollectible, but that word sales tells you it's a contra revenue. Okay. Ooh, LJ's in the lead. You ready? Here we go. On the terms 3/15 in 30, what does the 15 mean? What does the 15 represent?
It's really hard skipping from screen to screen because the options in the question doesn't show up on
Yeah,
Does it show up?
log. Yeah.
It
like
shows
on
the big old shape.
Oh my
Yeah,
god.
it just shows the shapes.
Oh no.
I got it.
4 of you got it right. I'm sorry, it isn't showing up. Felicia, though, you're getting this, you're second now.
Well, because I didn't answer the last one.
Oh, okay. This one's true or false. And the true is on the blue side. So the direct write-off method is GAAP approved. Is that true or false? The false is on the red side. The red triangle. The true is the, what is that, a diamond? Blue diamond?
I think it's a square turned sideways.
You guys all missed that one. Oh,
Blew
that's
it.
a bummer. Okay, so what is the GAAP approved one called? It starts with an A. It's called the allowance method. The direct
Oh,
write-off method
gosh.
is not GAAP approved.
That's
The
hilarious.
direct write-off method is not GAAP approved.
What's the
The
difference?
allowance
again?
method is GAAP approved. LJ
What's
still
the
in the lead.
It's not even on there.
Okay. When you estimate, yeah.
When you estimate the amount of uncollectibles, what account do you debit? The red triangle says bad debt expense. The yellow circle says allowance for uncollectibles. The blue diamond says accounts receivables, and the green square says sales revenue. What account do you debit when you estimate? Like the adjusting entry, the first entry we talked about today. I believe in you. You can do this one.
Yeah.
Oh man,
I got it.
it was. You got it, Ozzy.
Yes.
Oh, she's moving up.
finally.
Pooh Bear is coming up. What's the normal balance of the allowance for uncollectible?
Is the normal balance of the allowance for uncollectible?
Need me to read them to you?
No. What is the normal
Balance.
allowance for uncollectible accounts?
Here's a hint. Don't pick positive or negative.
Oh.
Thanks.
Yes. Thank God.
It's a
All
credit
right.
balance because it's a contra asset. Your assets normally have debit balances, and the green one said credit. Last question. LJ's still in the lead? Oh no, we got a new leader on the board. Last question.
Happens to your total.
Red says increase, yellow says decrease, blue says stay the same, and green, not enough information.
Okay, so under the allowance.
What
method-
happens to total assets when you write off bad debts?
Look at that little face. We cannot
That
change it.
raccoon stares right into your soul.
I want to donate money or something. Oh shoot, I have to answer.
Oh no.
Yes.
Stay the
Oh, I
same.
did it wrong.
One
Thank
asset
God.
goes up and one asset goes down when you do the write-off
First.
entry. So
Frickin'
the winner
raccoon.
is on the podium,
I got
Me.
second place.
Who's up there? Oh, Pooh Bear, you got third place.
Yes.
Alicia, you got second.
I was
Wasn't
like
it?
sixth and now I'm third.
LJ.
It's crazy.
right.
Yes.
Good work, class. I'm proud of you guys. We'll post another Zoom session sometime. I don't know when, but I'll work out some problems.
So is this one
And-
recorded and you're gonna post it?
Yes.
Okay.
Yes. It is recorded and I'm going to post it.
Okay.
So maybe Thursday problems, maybe we'll see what else works for the schedule. Okay.
Okay.
And I'll try to keep it shorter. So
Okay.
I appreciate you showing up
Thanks.
and I will
Thank
see
you.
you guys later.
Goodbye.
Bye.
Bye.